Thank you for watching our economic update video. My name is Dave Mantell, certified financial planner and partner with Stabler Wealth Management. Today we will be reviewing perspective on the economy, as well as a recent market volatility we've been experiencing. As you look through the headlines, we've definitely been going through uncertain times. We've been looking at 40-year highs in inflation, the Fed increasing interest rates more aggressively, the horrible conflict with Russia invading Ukraine, creating even more uncertainty, as well as a recent market turbulence as a result. Plenty of headlines and concerns for the media to really grab onto. One headline we've seen a lot of attention on is the recent highs in inflation. So inflation is currently at a 40-year high. As you can see on this chart, it's really picked up in the past few months, year to date. What inflation does is it decreases the purchasing power of money, with the concern being the squeeze on consumers as the prices of goods and services increase, especially as bank and money market rates remain near zero. Inflation is especially hard on cash and certain type of bond funds, as these dollars lose their purchasing power as they struggle to be able to keep up. Furthermore, high levels of inflation create the worry that the Fed will have to aggressively raise interest rates to combat this rise in inflation, which will in turn slow down the economy and potentially cause a recession. While high inflation and resulting rising interest rates tend to result in high levels of volatility as we're seeing, after settling in, the stock market does tend to do a fine job during these periods. Remember, rising interest rates is normal. That's a typical cycle where as you come out and the economy recovers, the Fed will start to raise interest rates again to keep it from overheating and combating rises in inflation. If you look at the past 12 rate hike cycles, the stock market has been up 11 out of 12 times and produced a very solid average return of 9.4% a year during each of these periods. While cash and bonds have a hard time keeping up with inflation and rising interest rates, the stock market tends to do an okay job as companies can pass on higher costs to their consumers and clients, and therefore keep up with these inflation increases. We've seen a lot of headlines recently predicting recessions. There's a saying in the investment community that economists were created to make weathermen look good. And so as you read a lot of these economists and articles predicting a recession this year, next year, and a couple years, it's really impossible to know when the next recession will be. A recession is defined as 2 consecutive quarters of negative GDP growth. It has proven very difficult to predict these periods, and while we are not currently in a recession today, remember they do happen and they're normal. While the first quarter of this year, we reported real GDP that contracted by 1.4%, adjusting for the historically high inflation, when you gross out that inflation level, we actually saw a very healthy 6.5% growth in GDP for the quarter. Especially when you account for the high level of US imports, trade imbalance, which further reduces that GDP number, it is actually a pretty healthy quarter. Arguably, the most important metric when it comes to the market is company profits, company earnings, which continue to be incredibly strong. In the first quarter, profits reported as of the end of April reflected 7% earnings profit growth, far outperforming the expectations going into the earnings season. Furthermore, full 2022 profit growth is estimated to be over 10%. Again, both of these being very healthy numbers. Now, we're recently experiencing a stock market correction. A stock market correction is a drop in the stock market of over 10%. While these are uncomfortable, they are not uncommon. On average, every year we see one correction at least. The average return from the peak to the trough at the end of the correction at the bottom is down just over 14%. Now, relative to bear markets, these corrections tend to be more short and sharp and are driven by more negative sentiment, such as the headlines we went over, as opposed to fundamentals. The average period from the top to the bottom for a correction is just over 4 months. And the good news is from the bottom, the forward returns tend to be very strong. Over 25% over the next 6 months, nearly 34% over the next 12 months, and over 39% over the next 24 months. Now, furthermore, this is a midterm elections year, which tends to make it even more volatile. The corrections during these midterm years historically have averaged down 17% from peak to trough on average, though the bounce back is even stronger on average, finishing up 30% from those lows. So these do tend to be pretty decent years despite the volatility. Now, of course, we don't know whether we're near the bottom or what the coming months look like, though it is helpful to look at history and remember that these periods are normal and tend to be why the market rewards investors over time. Remember, stocks are a long-term investment. Here's a recent quote we found from Warren Buffett. 90% of the people that buy stocks don't think of them the right way. They think about it as something that they hope goes up next week, and if it's down, they feel worse. I feel better, says Warren. I think about what the company is going to be worth years from now, and I hope it goes down when I buy it because I'll buy more. Now, we're not all necessarily like Warren Buffett where we're hoping the market goes down, but this is a good reminder that stocks are a long-term investment, and it's about those longer-term returns that really matter and where investors are rewarded. Remember, even those that are retired and are taking income, while they do have some short time horizons with some of their funds, some of your portfolio is meant to be longer term and keep up with inflation and things like that, like we discussed. And so, even retirees, it's important to have a portion in the stock market for those longer term wealth building results. While you can't predict what will happen, you can prepare. And there are ways to take advantage of a turbulent market like we're experiencing that we really focus on doing for our clients. So for those that are still working, regular contributions to your retirement and other investment accounts during turbulent times can be very powerful. This is called a dollar cost average approach. As what happens is when the market's down during that next pay period, you're buying in low. So over time, you're able to experience a rebounds with those new funds that are added. For all clients, looking at tax loss harvesting opportunities and non-retirement accounts can be very significant. And this is where we could find, temporary tax losses we can realize to save you on taxes as we go through these bumps and ups and downs. Also, timely rebalancing is something we really focus on to take advantage of the market volatility. We're going through uncertain times, so without a doubt, caution is still a key. And remember, we are prepared for these difficult periods. It's important to stick to the plan when we go through tough times like these. During challenging periods such as what we're going through, it's critical to be receiving sound financial advice. Please feel comfortable letting us know the names of anyone who could benefit from our services or this information that we provide. Again, one of our primary goals is to keep our clients informed, and we appreciate you watching our update. Please call us if you have any questions.